Now, I'm going to move through things fairly quickly. I'm going to spend no more than an hour. I would ask that as we go through it, you ask your questions. If I think the question it either requires an answer that I can't answer right now, or it's a long answer, we'll just take it offline after we're done here. If I go through something too quick, you stop me. Hey, Greg, I need to understand that better. Could you explain it again? So just time me out when that happens. Ask your questions as they come up. All right, and we'll cover this because no doubt you're not the only person with a question or the question that's being asked. So anything else before we begin? All right. Let's jump into this. First of all, I want to talk about two different types of reports that we have. We've got historical reports. Okay, what's happened over a period of time? Okay, the income statement, or sometimes, by the way, I'll call it the income statement. You might hear it called the P&L, the profit and loss statement. You may hear it called the earnings statement. They're all just different terms for the same report. So if somebody says, I saw it on the P&L, and somebody says, I saw it on the income statement, we're talking about the same thing. Okay? And then there's one called the statement of cash flows. Now this is the statement of cash flows. This isn't a budget. I put together my cash budget. That's different. This is a statement of cash flows. It's an accounting report that if you're using QuickBooks or any accounting system, probably it's one of the standard financial reports that you can generate. One of the three. Those are historical. They report on an activity over a period of time. So what happened last month? What happened last year? It reports on something that's taken place already. It's in the past. And that's a good thing to remember too. Remember, all these reports we're looking at are in the past. We're already past the period. So while they tell us something about what we've done, you still need budgets, you need other tools to help you manage where you're going. So those are historical activity reports. There's another one, the balance sheet. It's a point-in-time report. And we'll see why it is in just a minute. But the balance sheet says where are we right now? Right now. So it's as if you stopped your business for the moment and started counting things up. And when we talk about the balance sheet, you'll understand why it is that and why it's not an activity report over a period of time. So two types, historical and point in time. Here's the three financial statements. The income statement measures the business performance over a period of time. We talked about it's the what did we do statement. What did we do over the last month? What did we do over the last year? What did we do in business? Okay. And you all know that formula. Sales minus expenses, hopefully I have something left over equals profit, or sales minus expenses, perhaps maybe a loss. Okay, if my expenses are greater than my sales. But that's the statement that most people are familiar with, and I think everybody kind of operates on that one pretty comfortably. Balance sheet, okay? Balance sheet is a little different perspective. That's our point in time, okay? It's a snapshot of the business's book value. We'll talk later about what's the difference between book value and market value, because that's an important consideration. Okay? On a particular date, as though the company stood still momentarily and how the fund was. It's the what do we have? Now how many of you are really comfortable with the balance sheet? I wasn't either in the beginning. But you do understand balance sheets. If you own a home, you understand the concept of a balance sheet. You have a $100,000 house, and you have an $80,000 mortgage, and you have $20,000 of equity. That is a balance sheet. It's a personal balance sheet, but it's a balance sheet. And it's no different in business than it is in here. So that's what that one's all about. It's what do we own? What do we have that we can say, we can call it ours? And then of those things that we call ours, how much of it have we borrowed to purchase and we owe people for? How much of it have we paid for ourselves? That's pretty much what it is. So that's the balance sheet. Those things that we own are called assets. Those things that we owe to other people are called liabilities. And then the things that we can, the amounts that we can call our own is equity. And the third statement is the statement of cash flows, or the cash flow statement. Okay? Cash flow statement shows a change in a firm's working capital over a period of time, listing the source and use of the funds. Okay, what it really means is how did money come into the business and how did money go out of the business? And we'll see as we look at that, and this is, by the way, cash, not profit, cash. Okay, so we'll look at, there's three different sources of income that we group it into, three different sources of disbursements, money going out. We'll look at that when we get into it. It'll make sense to you at the same time. So 3 different reports, that's what we are. So it's the what did we do, it's the what do we have and who do we owe, and it's kind of where did our money go? That's what the third statement is. Let's break these down. Talking about the income statement, start with that one. All right, looks like the eye's off the page, but you know what the word is. Okay? The income statement shows the activity the business undertook in its normal course of operations. Okay? And now let me say this about income statements and businesses. There are simple business models and there are complex business models. An attorney or a consultant, pretty simple business models. You know, I have income, I have pencils, I have paper, I have some copying expenses, I have my wages, and that's about it. I mean, it could be that simple, right? Very, very simple. And the income statement would be very simple. On the other end, I have a manufacturer. Okay? They have sales too, but they have a lot of different expenses. They have expenses associated with making what they do. They have expenses associated with running the business. They've got some expenses that are partially completed, and it can be really messy. So it's going to, a manufacturer's income statement will follow the same general format as a consultant's income statement, but it will be much more complex. It'll have more moving parts, more things in it than what you'd see in a simple one. So we're going to walk through, not a complex one, but we're going to walk through one that has all the parts to it. So you can see there's, I just want to show you several sections. We've got a section here called sales and some costs. We've got some more expenses. We've got some other income and expenses. We have some taxes. So you see these chunks in the income statement. We see money coming in, we see categories of expenses, and we have either a profit or loss on the end. That's the general format of what we're going to go through. So let's take each one of these and break them down for a moment. Net sales. So we start with sales, and here's where you can follow your example that you have in your packet. Okay, number one is net sales. Well, sometimes you'll just see sales or you'll see revenue. Sometimes you'll see gross sales and net sales. Well, perhaps you're in a business that might get returns. Customer purchases something from you, but they return it to your store. So you sell them something, but then you give them their money back. So if we sold them something, we gave them something back, a discount, a return, we would have a net sale. So that's what the term net sales is. Kind of what do we have left over when we've netted out all the sales and returns, sales and discounts. So you have a section called sales. You can, whatever detail you want to put in there is up to you. Maybe multiple product lines. Maybe you're a restaurant and a gift shop, so you have sales for the restaurant, sales for the gift shop. You might organize things that way just to track them differently. Cost of goods sold. This is an expense category, and it's going to differ depending on the type of your business. But the term really tells what it is. It's the cost of the goods we sold. Cost of goods sold. So if I'm a restaurant, the primary probably cost of my goods sold is my food, the supplies, the ingredients, and food stores and things that I buy to make my items for my restaurant. If I'm a dress shop on Main Street, my cost of goods sold is dresses, no doubt. That's what I buy the most of. It's the cost of the goods, the dresses I sold. If I'm a manufacturer, the cost of the things I made that I got to sell is probably wood or steel or plastic or whatever I used, and the labor for my plant employees, those people that are out there getting the work done, making money for the company every day. So typically for a manufacturer, it's kind of labor and material put together. Not all the labor, but the labor that's used to make the goods we sold. Okay, so plant labor. That's what cost of goods sold is. So if we go back to our model, sales minus expenses equals some profit. But this is sales minus some of the expenses, not all of the expenses. It's the cost of goods sold expenses, but I still have a profit. It's a gross profit. That's a very important profit, because if I'm a manufacturer, that profit margin tells me about the efficiency of my manufacturing process. And since in a manufacturing operation, we make most of our money in the plant, not in the office, we want to know how efficient is that out there. So a gross profit margin is an important number to manage and to watch closely. If you're a restaurant, managing your food costs or your liquor cost is a critical component to the profitability of your restaurant. Those are your costs of goods sold. Sales minus cost of goods sold equals our gross profit. So that profit margin is an important one to watch. But remember, that is not a final profit. That's just a starting profit. We're going to deduct expenses from that yet. Okay, so we start again with our gross profit. We're down a couple lines. There's our gross profit. We still have expenses to deduct, and it's the expenses that are associated not with making what or producing the service or goods we sell, but with the parts of the business that need to exist in order for us to make what we sell. So that's where we have rent, insurance, bookkeeping fees, staff wages. It's all the support systems of the business combined together. We call those operating expenses. Sometimes you'll see them listed as SG&A, sales, general, and administrative expenses. It'll go by a couple different names, but it's the expenses that are not associated with the cost of your goods sold, but with providing that infrastructure of the business to enable the business to operate. Sometimes all of your labor, if you're a retail store, all of your labor may be in operating expenses, none of it in cost of goods sold. By the way, there isn't a rule about whether or not someone's labor needs to be in cost of goods sold or needs to be an operating expense. You kind of get to decide that. But remember, these are tools to help us manage our business. It's not just something that we do because we have to. I want to use these. The reason you're here saying is, Greg, I want to understand how to use these because they ought to be tools to making good decisions in my business. Well, if it's a tool to make a good decision in a business, then how you decide where things go in here is a little bit up to you. It's where does it make most sense for you to put it such that it gives you the best information that you can have in order to make good informed choices.